Welcome back to the Money and Meaning podcast, where we go beyond the numbers so you can worry less and live more. I'm Damon, and I'm here today with Elijah Mott. Elijah, welcome. And today we're going to be talking about taxes in retirement, and specifically a lot about how the One Big Beautiful Bill changes the landscape around that. I mean, taxes in retirement are a confusing subject, I think, for a lot of people anyway, and there's a lot of misconceptions, but now you throw in this whole new tax bill and you've got a recipe, I think, for people to just not know what to do or how it impacts them.
Yeah, certainly. And I think a lot of people tend to assume that taxes will either go away or significantly reduce in retirement. And in some ways, your taxes do go down when you're in retirement. But in a lot of ways, there are a whole new set of taxes that you have to worry about when you get into retirement. And a lot of people don't think about that going into it.
Exactly. And I think if you really think about it, your taxes in retirement can get more complicated. You know, when you're working and let's say you get a W-2, that's probably your only taxable income. Maybe you've got some interest at the bank, but for the most part, your taxes are pretty straightforward. But now fast forward into retirement and you've got IRA distributions are taxed in a certain way. Social Security is taxed in a different way. You've got brokerage accounts. You've got maybe a pension thrown in there. You've got all these moving parts. I mean, that's the bad news. The good news is that it's probably the first time in a lot of people's lives that they might have more control over their taxes, more opportunities, because they've got these different buckets and streams of income in the different taxations.
So you mentioned Social Security.
Right.
What a lot of people don't realize is that up to 85% of their Social Security can be taxable in certain situations.
Right. And for most of our clients, the reality is that they will hit that 85% of their benefit being taxable because there's technically three bands, as you know, a 0% tax, 50% or 85%, but the thresholds are very low. So if you've got a decent, retirement account balance, and they even calculate and include part of your Social Security benefit in that, most people, if you've done a decent job saving and have a decent Social Security benefit, should expect more of their benefit, not less of their benefit, to be taxable. And I know in the Big Beautiful Bill, there was a lot of talk of, your Social Security benefit is not going to be taxed, but that's not exactly how it was written, was it?
No. Of course, they like to talk about a lot of things, right? That's what the politicians do. But unfortunately, in the Big Beautiful Bill, it really didn't change the taxes on Social Security all that much. It changed a few things. There are certainly, I think we're going to touch on them today. There are some tax changes, but on Social Security, for most people, it will still be that 85%, especially if you're taking withdrawals from your retirement accounts to meet your expenses every month. And for a lot of people, those withdrawals are not optional either. When you reach a required minimum distribution age, you have to start pulling money out of those accounts. And that is going to boost your income up, and that's going to make your Social Security
more taxable. Right. So let's talk a little bit about that. Required minimum distributions, or RMDs. For most people around the age of our clients, that age will be 73, right? And that's the age you have to take money from those IRAs or 401ks or 403bs, whatever you haven't paid tax on, right? You have to take money out. And it's just the IRS's way of getting some tax revenue. But sometimes people don't think about this, is that taking those RMDs might push them into some higher tax bracket, right? Forget Social Security. You've got these different tax bands, and depending on how big your RMDs are, you might unknowingly or unwittingly push yourself into a higher tax bracket when you didn't mean to do that because you didn't properly plan before age 73, for example.
Yeah. And a lot of people don't realize that there are other implications outside of just standard income taxes, like the IRMA taxes that you have to pay when you have higher income when it comes to paying for Medicare.
That's one of the most common sort of rude awakenings that we see, because people don't think about, why am I paying more for the same Medicare I had last year? Or, my neighbor's paying $185 a month. Why am I paying $600? And people don't think about that. Those distributions from IRAs could actually push them up higher, like you're talking about, into those Medicare brackets. Sometimes people will sell a piece of property, whether it's their primary residence or an investment property. That counts as income for this Medicare calculation. So I think you raised this point a little bit earlier, which is if you don't plan around these things, you can fall into all these tax pitfalls that are really, by and large, avoidable if you have a plan. And the BBB, the Big Beautiful Bill, gives people some other opportunities, some increased standard deduction. There's this extra $6,000 per person if you're over age 65 that you get. So it's really looking at what are the current rules, what does the BBB say, and how does that play into trying to manage your tax bill, including obviously Medicare and social and other parts of it.
Right. Right. And it can really create this sort of domino effect, right? Where you have a higher income one year that pushes you into a higher tax band. So you have to pay more for Medicare the following year. And then since you have to pay more for Medicare, then you have to pull more money out from your retirement accounts, right? Which then you're taxed more on that. So it creates a sort of domino effect of taxes and surcharges that you really want to avoid by putting a plan in place.
Absolutely. And there's another round of taxes, which is capital gains tax, right? If I own some stock in a brokerage account that is not an IRA, I'm going to pay tax on the gains when I sell it. And I think that's, I think they know that, but they often forget that that is a taxable event and that there's ways to try to offset that, right? Tax loss harvesting. I could maybe sell some losers, sell some winners, and try to even out my tax bill that way. But it's a good bet to count on that at some point in time, you're going to have capital gains taxes, either from selling holdings that have done well or trying to sell holdings that have lost money. And how do you balance that out?
Yeah, certainly. And there's a lot of ways you can do that, right? You can have a proactive tax strategy in place, but there's also other pieces to that, right? Like gifting, like what you're leaving behind or what you're giving away while you're alive. There's different taxes on each of those, depending on how you give or when you give. So that's another big piece of this, where you have maybe stock that's highly appreciated that you want to leave behind to your heirs, or you want to give away to your family or to charity while you're still alive.
Right.
And then there's a whole other area where you can do that strategically to save yourself money on taxes.
Right, because you're sort of looking at two levels of taxes. One is, what am I going to pay while I'm alive, sort of year to year? And the second is, if I have X amount of money when I die, what are the implications from an estate tax standpoint to my family? And some of those levels get quite high. I mean, the federal exemption is around $14 million per person if there's a couple. So you're looking at around $28 million. But Massachusetts has a much lower $2 million estate tax exemption. So you're trying to navigate, if you've got that kind of wealth, through these different levels of taxation. And I get it. You could sort of like try to pass that tax bill on to your family. But a lot of people we meet with want to save taxes while they're alive, and they want to make sure that they're maximized what's being passed on. And that requires, I think, a lot of coordination, both with CPAs and estate planning attorneys and financial investment. A lot of times we just sort of see like this very siloed approach to all of that.
Mm-hmm. Certainly. And there's strategies too on what type of money you'll leave behind to your heirs as well, because every different type of money, whether it's tax-free, whether it's after tax, or whether it's pre-tax, they all have different rules and ways in which there are taxes on the inheritance if you were to leave that behind to your heirs. So it's important to have a strategy around not only how you pay the taxes while you're alive, but it's important to have a strategy on specifically what you plan on leaving behind and what is more efficient to spend while you're alive, what's more efficient to give away while you're alive, and what's more efficient to leave behind after you die.
Right, which is a lot of considerations. And, I think we're sort of in this period of maybe tax relief with the BBB. It kept the income tax brackets at 2017 levels, so they're staying lower. It kept the estate tax exemption at its current levels. It was set to sunset. So there's this sort of window of opportunity. And I think it's probably a good bet to assume that taxes will be higher at some point in the future, right? To pay down the debt, to manage the deficit. So the question becomes, what should I be doing now and next year? And while we have this tax relief, as you said, to sort of balance out all these different elements in the equation. But waiting and doing nothing, that's a plan unto itself. It just might not be the best plan.
Yeah, certainly. And when you look at the numbers on the pre-2017 tax levels versus now, I think a lot of people don't necessarily realize how significant the tax savings we have right now
Hugely different, right?
Yeah. I mean, for someone in the 12% tax bracket in 2017 levels, that was 15%.
Right.
That's a 3 basis point jump, which is roughly 20% increase.
Huge.
That's a massive increase in taxes that basically everything is at a discount right now. So it makes sense to have a strategy in place as soon as possible to take advantage of the environment that we're in now.
Right. And there's a whole bunch of different strategies. We talk a lot at our live events, on our radio show, and certainly on the podcast about Roth conversions, right? Taking some money out of an IRA, hopefully paying a little bit of tax now to save money down the road. And the new BBB with the increased deductions has given people maybe a little more bandwidth to be able to do those Roth conversions. but it's not a foregone conclusion that everyone should do them, of course. But just looking at what could I do this year? Is it a Roth conversion? Is it some tax loss harvesting? That's what we're doing with our clients, is looking at what are the opportunities, what are the challenges, and how do we do what's going to help them the most in a given year.
So when talking about strategies like that, another thing that we talk about in terms of giving, we touched on that a little bit,
right?
But with giving, there are certain areas where you can, different types of trusts you can create or funds that you can create where you can actually get a tax deduction for giving money away to charity. For most people, they don't itemize their deductions anymore, right? The standard deduction is about $30,000.
Right.
So if you itemize, you're not going to get there. But the thing is, if you're giving to charity and you're not itemizing your deductions, you're not getting any benefit from giving to charity. So with the donor advised fund, you can front load it and give, say, 5 years worth of giving all in that first year.
Right.
And then you can take that as a tax deduction and it actually benefits you because it's greater than what you would take at the standard deduction. You can itemize and then get a tax deduction in that first year and save yourself a lot of money, actually get some benefit on the tax front for giving to charity.
Right, and the charity's no worse for the wear. They're still going to get the same distributions you would have made. Or I've had some clients give highly appreciated assets to a donor advised fund. And there's a whole bunch of ways to approach something like that. There's other ways besides donor advised funds with charitable remainder trusts where you can get a significant tax benefit while you're alive, also benefit a charity, get some income back. And, this isn't the appropriate venue to go into all the details, but you can really balance your desire to give, which is a great thing, giving to charity, giving to your family, with what kind of tax benefit can you get while you're alive, not just what happens when you die. And I think that's a hugely impactful thing is, of course, you want to help a charity, but in the process, why not benefit your own taxes as well? That might mean you can save money and then do something else with the savings in some other part of your life.
Yeah, certainly. One other thing I think that we didn't touch on earlier when it comes to the one big beautiful bill is what they call the SALT deduction.
Right.
SALT is SALT, state and local taxes, where if you pay a significant amount in state taxes and local taxes, you can actually use those to offset the amount that you owe in federal taxes. And the one big beautiful bill actually increased the amount that you can use to offset your federal tax bill.
Right. It went from $10,000 to $40,000, which is a very significant increase. Now, that won't impact everybody, but we don't have the highest state income tax here in Massachusetts, but then again, we also aren't the lowest like our friends in New Hampshire or Florida, which are at zero. So it's worth looking at what is the impact on that. But I think the question really becomes, what else does that allow me to do, right? Let's say I can take advantage of that SALT deduction that you mentioned. It's kind of like, so what? What does that opportunity allow me to do? Could I give more money to my donor advised fund? Could I, do more Roth conversions? Could I give more money to my kid? I mean, it's really, the deductions are what they are in these opportunities. It's really what can I do about them and how does that benefit me or my family or my overall goals and desires with this money that I've saved.
Right. And that leads directly into what we would call coordination, right? Having a tax strategy in place is great, but you want to make sure that you have a tax strategy that's in place that aligns with your investments and your estate plan and the things that you want to do in your life as a whole. You need a comprehensive plan,
Absolutely.
Right? And a lot of people, unfortunately, they have these individual plans, right? Here's my investment plan. Here's my tax plan. Here's my estate plan. And none of them are talking to each other or working together. When in reality, all of those things have impacts on each other. So they need to be speaking to each other. And you really need to have one coordinated plan that encompasses everything and makes everything work together.
It's sort of like, I'm not a big football guy, but it'd be like having the Patriots having two quarterbacks on the field. It's like, who's running the plays or who's coordinating all this? You don't have a bunch of people just running around the field aimlessly. We see that a lot. And I think that unfortunately that's to the detriment of clients. And the more money you get and the more that's at stake tax-wise and otherwise, the more important it is to have that quarterback and have that coordination. Otherwise, we see this, opportunities will get missed or lost or misunderstood. And that leads to either unnecessary taxes or missed opportunities. And that's a shame, I think, when those opportunities are not capitalized on.
So here's the main takeaway then. Taxes don't go away in retirement.
Right.
They just change, right? And the one big beautiful bill changed them a little bit further, right?
Right.
And so if you want to learn more about that, you want to put a plan in place for your retirement, I would really encourage you to visit our website, southshoreretirementservices.com, set up a 15-minute introductory call, come to one of our seminars. We have all the links in the description. Please feel free to click those and take a look, because it's really important now more than ever to take these steps to get a plan in place.
This month, we also have an additional complimentary giveaway like we do every month. It's an estate planning guide entitled The Greatest Gift. And it talks about, for those couples or families or individuals that have more money than they need during their lifetime, tips and strategies for how you can use that wealth, give away that wealth. And great guide. Strongly encourage you to download it. Thanks so much for being with us. I'm Damon Tanzi with Elijah Mott. We hope to see you back here again soon.